to Equity Trust Company and began educating investors. And so to answer your question, as far as fears, the first one is not understanding the process and it being something that folks are not familiar with. So to break that down for folks, it's a simple 3-step process. So the first step of the process is open and fund a self-directed IRA. The second step is to direct your money to a real estate investment. We're talking about real estate here, so we'll focus on that. So direct your money to a real estate investment using your custodian. In this case, we'll say Equity Trust. And then the third step is manage and harvest your investment. And if we have time, Melissa, we can talk about more managing and harvesting the investment, and particularly around legacy and estate planning, because self-directed IRAs intrinsically have some really powerful tax benefits. Even more specifically, we can spend time talking about a Roth IRA, which is funded with after-tax money. It grows tax-free. And then when you take the money out in your retirement years, you pay 0% tax. A good example of this is a husband and wife couple that I started working with back in 2010, Kevin and Cynthia, and they referred to themselves at this time as stock market refugees. So they weathered the Great Recession, they recouped some of their losses, and they said, we're not going to continue to do this for another 10 years. And so in 2010, they rolled over their 401ks from their previous employers into self-directed IRAs, and they began investing in real estate. And over the course of 11 to 12 years, they've grown their self-directed Roth IRAs from about $200,000 to over $1 million in properties. And they now have over $130,000 in net tax-free cash flow flowing back into their Roth IRAs on an annual basis, all of which they pay 0% tax on. And then when they take that money out and they're over the age of 59 and a half now, that's the qualified retirement age, 59 and a half, they pay 0% tax. But what's interesting is Kevin and Cynthia don't want to use that money in their lifetime. They actually want to leave it to their children, or if their children have children, they're going to leave it to their grandchildren, and their grandchildren or their children will pay 0% tax. So IRAs, more specifically Roth IRAs, can be really powerful estate planning or legacy planning tools, and the IRA avoids probate. So I got a little ahead of my skis there, but I just wanted to give folks a little bit of seasoning in terms of the tax benefits and the advantages of an IRA. But the process is fairly straightforward. Again, open and fund the account, direct the funds for the investment, and then manage and harvest the investment. The other fear that I'll mention that a lot of folks have is with respect to making a mistake. Now, of course, you have the mistake of selecting an investment. This is a self-directed account after all. Now, could you make a mistake investing in the stock market? You certainly could. Could you make a mistake investing in real estate? I suppose you could do that as well. That said, a lot of our investors, including myself, the reason why they select real estate as an asset class is because of the intrinsic value in it being a hard asset. It not being an asset tied to Wall Street, but rather an asset tied to Main Street. So if you're somebody that feels as passionately as I do and many others, you're absolutely on the right call, and we're having the right conversation around using a retirement plan to invest in real estate. The good news is as far as mistakes are concerned, there are rules and guidelines, of course, with a retirement plan. And you'll hear and see articles written online, mostly by firms that can only sell certain financial products, that will say you have to be cautious of self-directed IRAs because of prohibited transactions. So you hear a lot of these, I'll call them fear mongers, who talk about self-directed IRAs and being able to blow up your IRA because you do a prohibited transaction. I've been doing this for 15 years, and the number of prohibited transactions I have seen is about this big in comparison to the thousands of transactions that I've worked on and I've observed. The good news is this. Back in 1974, the Employee Retirement Income Securities Act was passed. And if anybody is interested in staying here until midnight tonight, learning all about the ERISA Act of 1974 and the thousands of pages of legislation, Melissa, if you want to keep the call open, I know you'll probably need to get back to your kids, but I'm happy to stay on and spend more time with people. I'll probably be lucky to have at least one person still on the call. So let me just cut to the chase and tell you what the law did in 1974. Well, first, it created 401ks, IRAs, and other types of retirement plans. Prior to 1974, Americans really only had access to pensions and Social Security. And then 1974, we were founded and the law was passed that created all these IRAs and retirement plans. And what was good is when they created the law from a what you can do perspective was exclusive, written exclusive, not inclusive, meaning the law only tells us what we can't invest in, not what we can invest in. So what can't we invest in with our retirement plans? Well, we can't invest in collectibles. So no artwork, no stamps, rare coins. That's not permitted in your IRA. You also can't transact your IRA with certain disqualified persons. Very simple. You can't transact with yourself, your spouse, your parents, your grandparents, your children, your grandchildren. Just think anyone up and down the family tree, and then your spouse, and any businesses that you own and operate. So your real estate brokerage, your real estate business, if you have one, that's a disqualified person. So what does this actually mean? Well, you can't transact with these individuals between your IRA and these disqualified persons. And so an example would be if you own a property now, if you own real estate now, maybe it's a multifamily property, maybe it's a single family home. There's no way for your IRA to buy that property. You want to find a new real estate transaction to do with your self-directed IRA. If you have money in your IRA, you can't borrow against the IRA. Your IRA can't loan money to you. That would also be a prohibited transaction. And last but not least, you can't personally benefit from an IRA transaction. What do I mean by that? Well, let's say you bought a vacation rental. So this is the hot topic right now, right? A lot of people want to get involved in the Airbnb, VRBO, call it short-term rental game, which there could be advantages to that, of course. And some of these folks want to use their IRA, but they want to stay in the property even just 3 or 4 days out of the year. That would be a prohibited transaction. The IRS would look at that transaction. They'd say you used your IRA money to benefit yourself in the here and now, and therefore a prohibited transaction. When you read the rules and guidelines, it's actually quite common sense. And the good news is that's why we have training. You can go to our YouTube channel, subscribe, check it out. We have videos that show you what you can't do, everything else you can do. If you're somebody that's simply using your IRA to invest passively in a real estate syndication or partnership, for example, chances are good that you're not going to engage in a prohibited transaction because you're hands off from the investment. It's a passive real estate transaction. You're not the operator of the transaction. You're a limited partner in the investment. And so you're not running afoul of, or potentially running afoul of, any of the Internal Revenue Code prohibited transactions. And to conclude here, I'll mention that real estate is permissible in an IRA, of course, like we've been talking about, but there are naysayers out there. Just like we talked about, your financial representative, your financial salesperson may not be all that keen on investing in real estate with an IRA, or some folks have even said that you can't do it. If you go to the IRS website, irs.gov, and you search real estate IRA FAQ, so I'd encourage you to go there if you're interested in any light reading. If you're suffering from insomnia tonight, just go to irs.gov, search real estate IRA FAQ. I apologize, Melissa. That's my failed attempt at making a joke. I'm not all that, I'm not that funny of a guy. Unfortunately, I spend a lot of my time in the tax code, as you can tell. So I tell a lot of dry jokes, and people could just laugh at me. But in all seriousness, go to irs.gov, real estate IRA FAQ, and you'll actually see where it says that real estate is a permissible investment, but due to the administrative burden, financial institutions are not required to allow you to hold real estate in your IRA. So it's not a matter of legality, but rather a matter of choice. Most financial institutions can't make money, don't know how to, and they have no interest in holding real estate in your IRA. They would rather sell you mutual funds or traditional investments. So that's where you have to work with a custodian like Equity Trust that can actually custody these unique alternative assets, has the training, education, and infrastructure, the online tools to be able to help accommodate these types of real estate transactions.
Y'all, we knocked off at least 5 or 6 questions there. You were just riffing. That was perfect. So all of you that had those 5 or 6 questions, he took care of you. That was amazing. All right, I'm going to get to some of these questions in the comments really quick. So let's go back here. So Mark asked, what happens when a property is sold? Now, John, I'll explain from our perspective. So when we exit a property, when our investor has used their self-directed IRA or their 401k, what we do is we then exit, give the appreciation, the equity back into the IRA. Then once it's with the IRA, at that point, they can use it however they'd like. John, is that correct? Do you guys have a different system?
You're correct. So all of the income flows back into the equity trust IRA. So all your profits. If you're investing in a rental property, I think someone had a question around that. Your rental income would flow back into your self-directed IRA. When you're investing in a multifamily partnership, and there's preferred distributions, those are referred to as, okay, some people like to call them dividends to equate it to a public stock, but preferred distributions are going to flow back into the IRA. And then when there's an exit, to what Melissa was talking about, so there's a capital event or there's an exit, then the proceeds are going to flow directly back into the equity trust IRA. And it's really important that you have that flow going back into the equity trust IRA, because that way you're not creating any type of taxes or penalties. If you tried to take that income personally, that would be a distribution, and it would also be a taxable event. And if you're under 59.5, there would be penalties there. One of the other questions that I saw that came up, Melissa, was with respect to equity trust and how we would get paid, so to speak. So we operate as a custodian. We're not a typical assets under management fee type firm. We're not making money when you sell an asset. We just charge a basic custodial fee. And you can actually go to our website, trustetc.com/fees. I can post that in the comments there for everybody. And you'll see our fee schedule. It's pretty straightforward. For example, if you moved over $150,000, you'd pay a $500 maintenance fee. That's all inclusive. It includes all transactions, investments, record keeping, reporting. So I'll pause on that because you can find more information. You could always reach out to us here at Equity, and one of our associates can provide some more instruction on that particular topic. The other question I saw was with respect to a rental property or rental income. What happens? How would adding capital for for maybe a down payment, like on a residential rental property type example? So your IRA could potentially buy, let's say, a single family residential rental property. If you had enough money in your IRA, then you would be a cash buyer in that purchase, and then all rental income would go back into your IRA. If you don't have enough money in your IRA, then you would have to come up with financing elsewhere, whether it's through partnering with another IRA, partnering with a family member, which there could be the potential to do that, or you would have to find what's called a non-recourse loan, meaning that you would have to go to a special type of bank or lender that's willing to lend your IRA money without you signing a personal guarantee. See, one of the things a lot of people aren't aware of is if your IRA is going to buy real estate directly, so you're not going through like a partnership, your IRA is going to buy real estate directly. In those circumstances, if you're going to obtain a loan, you can't sign a personal guarantee. And most banks will not loan money to someone unless they're getting a personal guarantee. Now, if your IRA is investing in a multifamily real estate partnership and you're a limited partner, yes, the bank that's on the transaction or lending on the transaction is likely going to ask for a personal guarantee, but they're not going to ask you to sign the personal guarantee. They're going to ask the GP or the manager of the fund to sign the personal guarantee. So you're okay to use your IRA to invest in a real estate partnership because you're not signing that personal guarantee. And that also leads me to another fear, Melissa, that I should have brought up, which is the fear of, I don't have enough money to invest because my IRA doesn't have enough capital in it in order to be able to go out and buy a rental property or a multifamily property on my own, a 4-unit, 8-unit, 5-unit, whatever it is. And so that's where we do find a lot of investors are attracted to the concept of using their IRA to invest in a partnership or invest alongside other investors because they haven't built their IRA up to a balance where it's ready to start participating as an investor completely on their own. And then, of course, plenty of investors that's not in the cards for them. That's not in the financial plan for them. They want to just exclusively invest in passive real estate transactions. So hopefully that took care of some of the questions that I saw in the comments as well.
That did. It was perfect. Thank you, John. And so Linda, I actually spoke with Linda today. So good to see you on here, Linda. She asked, what if I don't have a Roth IRA, but it's just a traditional? How does that work? And also if she's over the age of 60.
Sure. Great question. So whether it's a traditional IRA or a Roth IRA, that's okay. You can self-direct either account. And for those that aren't familiar, a traditional IRA, so most 401ks, 403bs, thrift savings plans, most workplace employer plans are tax deferred accounts, meaning when money was going in, you were getting a deduction for it. It grows tax deferred. You roll it over into a self-directed traditional IRA, which is also tax deferred. That way you have no taxes or penalties. You invest and it grows tax deferred. Tax deferred growth, compounding interest in the absence of taxation is what I always say, can still be very beneficial to you. For those of you that say, you know what, I would rather pay taxes on the smaller seed so I don't have to pay it on the much larger crop. In that instance, you could actually convert your money over into a Roth IRA. So you got to pay some taxes when you convert the money over, but you can convert it over to a Roth IRA, get the taxes out of the way now. It grows tax-free. And then after the age of 59 and a half, you pay 0% tax. The second part of that question was with respect to age. So whether you're 30 years old or 80 years old, it doesn't make a difference. You can have a self-directed IRA, you can invest. As far as contributing to an IRA, if you want to contribute to an IRA, you do have to have earned income. So if you're in retirement and you don't have any earned income, you won't be able to contribute. But if you have existing retirement money now, IRAs, 401ks, whatever type of retirement plans, there's nothing that's going to stop you from rolling it over into a self-directed IRA and continuing to grow that account far into your later years. I have plenty of clients that are in their 70s and 80s, and they're in preservation mode. They're in legacy planning and estate planning mode. And so they're using Roth IRAs to leave a legacy to their children or grandchildren by buying income-producing passive real estate transactions.
That's awesome. So we have a question in regards to that. It says, do they have to transfer? Does all of the IRA capital have to be transferred to the self-directed account? If it has to be transferred, are securities of public companies allowed alongside real estate investments in a custodial account?
So answer is yes, you can move over all assets if you want. In 98% of cases, if you have an IRA with stocks, mutual funds, ETFs, bond funds, in most cases, Equity Trust is going to be able to custody all of those assets under one roof. The question would be is, do you want to do that? So some people, they may still want their mutual funds and stocks with a traditional custodian, which is okay. And then in that instance, they would just do a partial transfer from account A to account B. So to answer that part of the question, you don't have to move all of your money to Equity Trust. You could just move what you want over to Equity Trust for your investment in real estate and leave everything else where it's at. And then let's say your first investment in real estate with your IRA works out really well, and you want to reload, I'll call it, money into your same Equity Trust IRA from that other IRA. That's fine. You can simply just cash out whatever securities are in that other account. You're not liquidating, paying taxes and penalties. You're liquidating just into cash. And then you just do a transfer to your Equity Trust IRA. And as long as you're following the process, there's no taxes, there's no penalties. You're just moving from one bank account to another. And I think that was one of the other questions someone had, was with respect to how do I actually do that? Which is simple as you would reach out to Equity Trust, very easy to do. You'll talk to one of our associates. They're not here to sell investments to you. So you have the freedom and flexibility of working with them. They'll help open your account. The account open process is very simple. It's a 5 to 10 minute process over the phone. Transferring or rolling over your money from your current financial institution, that can take a little bit longer because we're at the mercy of another financial company that's usually not willing to give up the money overnight. So you want to make sure if you want to make offers on properties, you have a tight timetable, you just want to make sure your account is set up and funded well in advance.
Awesome. The other question that Michael has is, what happens to depreciation benefits if you invest via IRA? Do those get lost?
Good question. So with IRA accounts, they're tax exempt accounts. And so the way it works is your IRA is tax exempt and there's no taxable income in most circumstances. So in that case, if there's no taxable income, there's no income that can be offset by depreciation or your pass-through expenses. Okay. Now I said in most cases. So here's, call it one exception. If your IRA is invested in a debt leveraged real estate acquisition, that is the one instance where your IRA can be subject to a tax that's special to IRAs or unique to IRAs, known as unrelated business income tax, UBIT tax for short. And it's not something that I find in my experience investors are overly fearful of. Some are because they don't understand the rules. The good news is we have another training video, short training video on YouTube that you can check out that will teach you all about this. And so what this is, to give you the high level overview, let's say you bought a property for $100,000 and you borrowed $50,000. So your IRA buys it, your IRA borrows $50,000 from a non-recourse lender. And so you're at 50% leverage. And that circumstance, 50% of your net profit, that is your profit after all of your depreciation and all of your expenses are recognized. 50% of the net profit is subject to this unrelated business income tax. So in many instances, investors have enough depreciation and expenses to offset the unrelated business income tax. So to summarize this for the question that was asked, if your IRA owns a property 100% outright as a cash buyer, then there's no taxable income. Because there's no taxable income,